After all the recent controversy regarding the reverse stock split, SoFi is once again caught in the spotlight as the company files a shelf registration with the SEC on July 15, 2022. Now, this has left a lot of Sofi'S soldiers confused.
What the heck is that?
In this video, we'll go over the key details of SoFi's shelf offering, what it means, the advantages of having a shelf offering, and the connection it might have with the recent approval to effect a reverse stock split. We'll also discuss how many companies have shelf offerings in the recent years. If you want to know how this affects you as an investor, be sure to watch until the very end. We're not financial advisors, and this is not financial advice, so always do your own due diligence. If you haven't already, make sure to follow us on our social media pages at WealthGAMBIT. The links will be in the description box below. Days after SoFi's first shareholder meeting as a publicly traded company, SoFi filed a form to the SEC for a $1 billion mixed shelf offering, or a resale of capital. If you don't know what it does for SoFi and what this means for you as an investor, then we've got you covered. First up, let's talk about the shelf offering. According to Investopedia, this is a right granted by the SEC to companies issuing equities to register a new issue of securities without having to sell the entire issue at once. In other words, SoFi can make more public offerings 2 to 3 years from now, and to make it hassle-free, they only have to register these all at once. It's called shelf offering because the company is pretty much storing pre-registered shares in a shelf.
Yeah, totally. That makes sense.
Any company can use common stock, preferred stocks, debt, or any security they want to offer, but usually it takes a really long time to complete this process. According to thebalance.com, it can take 6 months to 1 year to bring a new offering to the table, and it can take a big chunk of a company's capital for every offer. Stocks in the shelf offering can either be a primary offering or a secondary offering. It's a strategy for companies who want to raise capital and at the same time save money to better execute their long-term strategies. But there's more to that. If you wonder how it works, stay tuned until the end of this video to find out. When a company makes a shelf registration, what's going to be kept on the so-called shelf is recorded as treasury stock. And to be more flexible in this highly volatile market, SoFi can use this as an edge to be cost effective when it comes to issuing the securities when they think the odds are in favor of them. To keep up with the shelf registration move of SoFi, here are 3 key advantages to this move. Number 1, shelf offering gives a company the upper hand over the market. With inflation and other macroeconomic factors always getting in the way of everyone's business, this move allows a company to take control of what it can do in this volatile market by selling the shares from the shelf at the right time. Number 2, a shelf offering frees a company from paperwork and legal obligations, which makes it a cost-effective move. When a company acts on a shelf offering and finally issues it to the market, it's free from governance regulation because it registers all at once, making it incur minimal expenses. Number 3, a shelf offering is fit for companies with long-term strategies. According to Investopedia, the primary advantages of shelf offerings lie in timing and certainty. In our opinion, it's an excellent strategy that companies can use, especially when focusing on growth and expansion. As of June 30 this year, 922.1 million common stocks of SoFi exist and 32 million shares of Series 1 preferred stocks. With this shelf offering, SoFi won't issue any new shares. It will all come from the existing shareholders. On top of that, it will also include the exercise of previously outstanding warrants, stock options, restricted stock units or RSUs, and SoFi's preferred stock. SoFi says it's not going to receive a single dollar from the resale of the shares. Instead, it's going to earn from the exercise of warrants and stock options. SoFi can receive about $108 million if all outstanding warrants are exercised, and about $142 million if people choose to exercise their stock options. According to their SEC filing, SoFi will use the proceeds for general corporate purposes, aka working capital, acquisitions, the retirement of debt, and other opportunities they can get to capitalize for growth. The authority to effect a reverse stock split has been approved recently on July 12th at the SoFi 2022 annual shareholders meeting. 3 days later, SoFi filed a $1 billion shelf offering. This news left a lot of SoFi investors confused. While reverse stock split reduces the number of shares an investor holds, shelf offering eventually causes dilution, at least according to PocketSense.com. PocketSense states that a shelf registration still causes dilution, and many investors use fully diluted share counts in their calculations. A shelf registration can still send a stock price down, but its effect may be less dramatic than that of a straight secondary offering. In our previous videos, we discussed that the idea of a reverse stock split is to to increase the price per share to make it an attractive investment to institutional investors. And as we have previously discussed in this video, one of the advantages of a shelf offering is that SoFi will have the power to increase the number of shares in the market whenever the company sees a favorable opportunity. But this is just our opinion, and take it with a grain of salt. If you're worried about SoFi's shelf offering, then you should know this: shelf filings are becoming a new trend in publicly traded companies. According to research firm Audit Analytics, in January 2021 alone, 56 forms of original shelf registrations had been filed with the SEC, and in 2020, 844 companies have submitted their forms original shelf filings. These figures, according to their data, were the highest in the last 10 years. At one point, Mark Lehman, chief executive of JMP Securities, even said, "A shelf registration is like having something in your cupboard. You can open your cupboard and grab it. If you don't have it, you've got to go get it." In other words, it's better to have it and not need it than need it and not have it. Commander Noto, in multiple occasions, has expressed that the authority to effect a reverse stock split to SoFi's board of directors was a break in case of emergency, and in our opinion, SoFi's $1 billion shelf offering could be one of the company's next moves after the break in case of emergency happens. Regarding the reverse stock split, if it were to happen, SoFi's stock price will increase, making it favorable for SoFi to release a portion or all of the stock sitting on its shelf in order to raise capital and attract more investors, which eventually lead to a higher market cap. On the flip side, history has shown time and time again that a reverse stock split is never good for a company. This news alone caused many SoFi investors to sell off their shares. Buy high and sell low, right? Just kidding. Let us know where you stand on the reverse stock split, and also, what do you think about this shelf offering? We'd love to hear your thoughts in the comment section down below. Shout out to all of you who commented on our previous video. Special shout out to everyone in our Patreon community. You guys truly help to make these videos possible, and we really appreciate all the support. Shout out to Arthur Magazu, Wei Chu, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Bo Park, Denzil, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Bofrand, Jay Bone, Daniel Zinson, and ABC Sam. If you get any value from this video, make sure to like and subscribe, as it helps a lot with the YouTube algorithm. Also, don't forget to turn on the notification bell so you'll be updated once we drop a new video. Thanks for watching, we greatly appreciate it, and until next time, peace.